Moving on, the big market guest this afternoon, Prashant Khemka of White Oak, is joining us now today to talk about markets. As we told you, a galaxy of important guests coming on ET Now to celebrate our 12th anniversary, and Prashant is one of them. Prashant, good afternoon. Thank you so much for taking time out with us, talking on this special day. We truly value our association, Prashant.
Thank you, Ajay, for having me here on this special day. Congratulations to you and everyone at ET Now. Can you hear me?
And in fact, happy anniversary to you too. I do remember just a few days back, you also celebrated, or White Oak celebrated their 4th anniversary. So great to be, seeing
Certainly
your organization also take shape so wonderfully. Prashant.
Thank you.
Great. Prashant, one of the big events to watch out for was last evening from practitioners' point of view. Strategists have been talking about it. It was almost getting priced in that the Fed would talk about taper, and that talk did happen. So perhaps market was a bit already factoring all of that in. But how would you analyze that data points? Yes, you have said before that macro data points are just observations, and stocks and micro do not really get impacted a whole lot. But still, this one was clearly an important one from the liquidity point of view. What are your thoughts?
Sir, no, thank you, Ajay. So see, I think, as you said, it's very well anticipated and feared or whatnot. So it is not as sudden or shocking for the market. The Fed is also observing the data, and in the near term, the inflation numbers are coming in higher. Fed is of the belief that it's transitionary in nature, and I would like to believe they know better than us and better than most others. We also are in the camp that because of the supply chain dislocations related to the pandemic, there is a certain transitionary element to inflation. Now, how much of the inflation is transitionary element and whether there is any structural element or not, it's impossible to say as of this time. What the financial markets and the Fed as well would be wary of if there is a reset higher to inflation, long-term inflation expectations. What the inflation is over the next 12 months, 24 months, 3 years is not that material for the financial markets. It's what the inflation expectations could be for longer-term inflation, which has been very benign. These inflation expectations has been very benign for the last several years. If there is any change to that, then that could have greater repercussions. And to address that in time, the Fed might act, preemptively, or if not preemptively, if preemptively is not the right word, to address that, Fed might, increase the rates or taper or whatnot to keep a check on inflation expectations. Right now, there is no such material risk of inflation expectations running away. But that is something that is what Fed and other market participants are always wary of.
Right. Prashant, let's talk about your portfolio composition. I was looking at a portfolio. You have large holding towards private banks, both corporate-centric as well as retail-centric. In fact, clearly, retail-centric private bank pocket have a bit underperformed in the last 8 months to say 1 year, and corporate banks have really taken the lead. What's your hypothesis there in both sides of the allocations as the economy actually opens up going forward?
So see, the team, as you know, Ajay, well, the team has an approach of very bottom-up stock selection-based portfolio, though team does consciously like to have a balanced portfolio, in that we don't take a view on the direction of the market, nor do we take a view that is materially different or any significant degree different on the economy from what the consensus might be. That's our style, that's the approach. Uh, so we like to have a balance in the portfolio. There are certain areas of the cyclical segments, such as industrials, such as some of the material segments like cement, autos, and all, where the team struggles to find good investment opportunities. At the same time, amongst the domestic cyclicals, the team finds quite a few attractive opportunities in the financials, and the team has for very long held large exposure, large allocations in the private sector financials, and it is not much different at this time. More particularly talking about the retail versus corporate, as you know, that these were terms that were maybe true in describing the character of some of these private sector financials asset side maybe 10 years ago. But what were the banks that were considered 10 years ago to be more corporate might in fact today be more retail than the other banks that were 10 years ago considered to be retail but are actually today more corporate. I think the distinction between retail and corporate is no longer as applicable today as it was many years ago. These banks that you're referring to, they all have very strong retail liability franchise. They're the best retail liability franchise in the country. In fact, the liability franchise is such that would be extremely difficult for banks, new banks in the future to be able to replicate. And on the asset side also, all these banks are now within, comparable, very comparable percentages in terms of the retail to corporate book. So I would not distinguish. I think the distinction is more matter of perception now than reality.
That's a wonderful point you made, Prashant. In fact, I would totally agree with you, because if you see SBI, which is seen as a corporate bank, the highest growth in their loan book is actually happening on the retail side, and vice versa. HDFC banks of the world are going now quite aggressive on the corporate side. So I totally get what you're trying to say. Let's shift focus and talk about some of the manufacturing related plays, some of the electronic manufacturing, quasi consumer durable plays, which you also have largely, and which have surprised a lot in the market. The way these companies got listed in no time have gained such a lot of market share as well as market capitalization, and now they're talking about expanding their product base and big opportunities. So there are a clutch of them itself. How do you see this really evolve in the next 3 to 5 years now that PLI is also taking shape?
Excellent point. And the team has been early in identifying these opportunities, I would say. See, many other countries in Asia have for decades, obviously led by China, cornered the status of manufacturing hubs or being just the manufacturing playground of the global for global requirements. And India was left quite far behind on that front. However, over the last 5 to 7 years, there has been a concerted effort to gain back our fair share, if you will. There have been policies that have been put in motion, both carrot and stick approach, carrot in terms of incentives, stick in terms of higher tariffs, and compared to, let's say, decades ago, the ease of doing business, such kind of a business, has certainly improved. And as a result, you are seeing companies that are setting up these, what you may call electronic manufacturing services, where people outsource the manufacturing of TVs or LED lights or even consumer durables. That industry is taking hold in India. The earliest movers have a decade or two of advantage in terms of time advantage. They've already scaled up the curve. There are foreign players coming in and setting up shop as well. The PLI scheme, as you noted, is one of the most successful schemes and implemented so far in a very efficient manner. And companies in this industry have lived up to the expectations of the market, I would say, and our expectations as well. And we expect them to continue market share in an industry which is gaining market share from regional peers or in the global context. And when you're gaining market share on top of a country gaining market share in a fast growing segment, growth rates are very robust and strong. And the profitability, the business models being such, especially the ones that the team has invested in, the profitability is very strong as well. And hence the price movements that you alluded to in the marketplace have been quite rewarding as well, Ajay.
Right. Prashant, let's talk about, the IT space. You have a very good mix of names there, large cap, mid cap. In fact, Intellect Design, be it Infosys, Coforge, Persistent, all of that are the names that you are looking at for some time now. If I were to take a leaf out of commentary of, Infosys from the recent JP Morgan conference, or even TCS commentary from their annual report, or Gartner Forrester commentary, it appears that they have found their mojo back. The entire IT space is buzzing and are talking about better margins and growth, perhaps got to do with the US coming back. What are your thoughts? You have also spent a huge lot of your career overseas. Are you indeed seeing higher growth for Indian technology companies or technology companies overall, or use of technology, which will ensure that the order books and deal pipeline remains healthy? What are your thoughts there?
Are you making, Ajay? So there are two elements here, the structural aspect and then more near term, next few years aspect, right? And structural, when I mean, I'm talking more like, let's say, decades kind of time frame. Our team has always had good success in identifying great investment opportunities. I can't talk obviously about specific names here. The opportunity also is there because there is from a structural perspective, we find an entrenched misconception or myth amongst investors that IT services is a mature sector. It's a X growth or low growth sector, which can't be farther from the truth. And we've never believed in that. The reason many investors and market participants have, in my view, misled themselves into believing this is because they hear about these growth rates that IT companies talk about or industry bodies like NASSCOM talk about, where they talk of 7 to 8% growth or high single digit growth. And that sounds in the Indian context somewhat low, because almost everyone, double digit growth seems to be birthright of every company in India, because the nominal GDP is growing double digit in India. But an important distinction, a very simple, straightforward distinction that I think people, analysts, investors fail to make is what these companies, IT services companies and industry bodies are talking about. They're talking about dollar growth. So when you have a 7 to 8% or 7 to 9% dollar growth, in rupee terms over time, that translates into 11 to 14% rupee growth, right? Because the 3 to 5% rupee depreciation or 3 to 4% rupee depreciation over longer periods of time is what has been the experience, and is also reasonable to expect given the inflation differential between India and the dollar economies. So 11 to 14% growth is no small change. Very few sectors in India are able to grow at 11 to 14% at a sectoral level I'm talking about. Obviously, within that, then, there are companies which grow much faster, like in any sector, be it banking, be it consumer or pharma. There are companies that grow faster structurally, and there are companies that grow slower. So our team is able to find companies that are growing mid-teens or higher, or even in 20s. We expect them to grow at valuations that are extremely attractive, because people have kind of labeled the whole sector as a mature or ex-growth sector. So that's the structural aspect of why we find very attractively opportunities in this fast-growing sector that is misunderstood. From a near-term perspective, you are right, Ajay. One of the things that the pandemic, while a lot of negatives about the pandemic people were worried about in the initial few months, there are certain positives as well from an economic growth perspective, not only in India but globally. And one of that is much faster adoption of technology, not only in our day-to-day lives as is happening right now, but also driven at the largest of the enterprises, global enterprises. What was discretionary IT spend till a year and a half ago is in many situations a necessity without any alternative. So the shift to many of these technologies, which was happening at a steady, gradual pace over the years, has been accelerated. So, as many of these CEOs, ranging from CEO of Accenture to TCS to Microsoft, they've all mentioned that, as an example, moving to the cloud, right? That was happening at a certain pace. Business case was being made at the boardroom levels and all. And in many companies, it would have taken a decade. But post pandemic, this acceleration is happening within a year's time, 2 years' time, 3 years' time. And then there are all those ancillary services and related services and products that have to be supplied to accomplish that. And IT services sector is in the midst of it all. So they are seeing a rapid rise in the demand environment. The worry, if anything, is on the supply side, not on the demand side at this time. And hence, what you said, yes, the prospects, not only from a longer term, but next 2 to 3 years or 4 years, look very promising for the companies in IT services sector in general, and particularly companies we own in the portfolio. Back to you, Ajay.
All right, Prashant, we'll let you go on that one. Thanks so much for your inputs this afternoon, and have a great day ahead. Thank you so much for your time today on this special day.
Thank you, Ajay. Congratulations once again. Talk soon.
On that note, time for a short break.